Good morning, everyone. Welcome, everybody, to the blockchain fundamental session. My name is Alex Rodell. I'm the vice chair of the Personal Investing Network, one of the chairs for today's event. We're going to skip a lot of the formalities. We just want to try to maximize this module, and we'll do that at lunch and do it properly. It is my honor to introduce Roberto Ponce this morning. Just bear in mind we need to be across the room at 11:10. So this will be a brief session. You will all get the copy of the presentation in your email, hopefully tomorrow. So just about Roberto. Roberto is based in Costa Rica. He's the founder and managing director of Invermaster Ventures and a partner at Corco Private Equity. He's an accomplished financial advisor, was a partner at Bain & Company, has an MBA from INCA, Inca, and he's a pilot for the Argentinian Air Force. So without further delay, we'll just go straight into it. Thank you.
Hello, can you hear me? You know, people usually in this event share how they enter into this space of cryptocurrencies. My story was kind of interesting. I all started with a breast silicone implant. We invested in a company that produces silicone breast implant in Costa Rica. Now it's becoming one of the biggest companies in the world. So basically they told me, no, you're Argentinian. They owe us money. Go get the money, because at that time you cannot collect US dollars in Argentina. So they sent me to Argentina and said, you know, try to get some money, because it's been a year already. So the Argentinians told me, you know, we cannot get you the US dollars. There's a sort of problem here. They took me to that time what they call the Bitcoin embassy. They gave me $200,000 worth of Bitcoins. And late in that night, I sent the Bitcoins to an exchange and exchanged the Bitcoin for US dollars. So at the end of the day, I was in a Starbucks in Argentina in early 2013. And I started thinking about, wow, something's going on here. How come so fast I send money from a country? There were restrictions. I exchanged the money to US dollars. I paid the company. So I started thinking about what's going on Bitcoin. Obviously, Argentina, because they had so much trouble in getting the US dollar. There was a huge startup ecosystem over there. So basically, that's how it started. Nowadays, on the crypto space, we just closed our first fund, closed and liquidated our first fund. We accumulated almost 2,000 Bitcoins, 112,000 Ethers, and we sold it during December and January this year, obviously with a handsome profit, and the investors were very happy. We also invest in almost 20 ICOs this time, around $17 million worth of cryptocurrencies. So we are fundraising for our second fund at this moment. We have all the experience trying to open bank accounts, try to comply with regulations, every changing. So you will see in this conference, how the space is changing. Yesterday, there was an announcement that some state, I think the Wyoming state, declared the cryptocurrencies as one of the assets, as a special asset. Today or yesterday, Google announced a ban on the ICO's advertisement. So every day something's going on. So let me introduce you a little bit about the fundamentals. It may be, I would like to use the very basic concept of blockchain, like an overfly across the crypto world, and some ideas how we can apply the blockchain to the business world. You know, maybe the say written in stone started like 7,000 years ago. The need for a centralized ledger, the need for a ledger was evident in our ancestors. And I think that's becoming the key part of the most important part of the cryptocurrency world. Because when they record transactions, when they record at that time, the person who controls the ledger, the person who controls the stone at that time, obviously has a lot of power, because not only he controls what goes inside the ledger, but also on the property of the ledger. Obviously, the centralized system at that time was very difficult, because the stone can be stolen, the stone can be broken. The centralized system was kind of a problem for every transaction they record. So when we have the option now, because internet nowadays, on the centralized system, how to record transactions, basically that was when the world opened their eyes. The decision of who enters the control of the transactions, or the information that is inside the ledger, or the processing of the information, the opportunity to have a distributed system, a system where if a node fails, one of the nodes fail, or if there is a rogue node, or there is something happening across the network, the difficulty of getting a wrong ledger is less than before. So there is evident now that is a really interesting opportunity for decentralize all the system. It's 10 years already, most passing since this famous white paper. If you see the white paper, you read the white paper, basically the person or the group who wrote this white paper combined three things that were already in the world, no? For most than 30 years. The cryptographic public key transactions, the cryptographic public key protocols were already there. People were using that protocol for many years in order to exchange information, in order to exchange securely information. The P2P network, remember Napster, a while ago, they basically made famous the idea to exchange information between parties, between persons, between peer-to-peers. And also basically they put everything together in a software, in a protocol, in order to exchange information. At the end, it was that. At the end, it's not like the creation of a currency. It was not the creation of a new, it was just putting together very nicely, in a clever way, a form of transmitting information, a form of putting in a public information, in a public ledger, and a form of securely transmitting value across a system, across a peer-to-peer network. If you look at this, it's basically a new protocol. Some people compare this as a protocol for internet. I remember when I was in the Air Force, we had a program that was connected to the MIT. It was at the very beginning of the internet. So basically the TCP protocol. Now I can see this as a protocol of money. Basically, if you look at that, you can think about all the potential that we can do with this new idea of combining public key or the private public key information, the network value of the peer-to-peer transaction, but also putting everything in a block. So the idea of blockchain came with that. No? Basically, it's a bunch of information, a timestamp, and some data that can be transmitted across a network. That is a block in a very simple way. Then they put the blocks in an order, then they put the blocks in some sort of competition, then the blockchain is created. So basically, mining the block is, in a simple way, is they bundle those transactions, that information that is broadcast across the system, they bundle, they verify the transactions, and they do some math problem. Usually in my class, I compare the math problem if you have ever used Excel, you know, the goal seek. You know, sometimes in Excel there is a functions that try to guess a value. Basically, that's a math problem. In this case, they use a hash, which is a function, which is a computer in the case of Bitcoin, a function that is transacted, it's a calculation basically. It could be a lot of waste of energy in that calculation because the function is a mathematical problem that requires a lot of computer power, a lot of calculations. When they solve the problem, the first one to solve the problem is the one who will put the block in the chain and then goes over again the whole process every 10 minutes in the case of Bitcoins. And the ledger is propagated across the network. That's the very basic stuff in terms of how the blockchain is born. You can have many combinations. You can have nowadays different ways to solve different math problems. You can basically, there are so many applications that is going on, but at the very beginning, the blockchains or the mining concept was that. When you started the mining, if you remember, you can do it in your own computer. Now requires a specific hardware, now requires a specific computer power, and obviously energy is one of the biggest issues here because that computer consumes a lot of energy. We have a mining operations, for example, in Guatemala that is plugged into the hydropower facility. Basically, we connect to the hydropower directly to the computers because the world now is looking for sources of energy cheaper in order to compete in this gigantic, basically, competition about how we can access to the blockchain, how can we add a block into the blockchain. When the blockchain is born, the public ledger, everybody can check, everybody can see what's going on inside. Obviously, we don't know the private keys of the persons, but there are some software nowadays that you can basically track the transactions, and if you tie the keys to a person, you end up knowing what's going on from the very beginning of the coin up to the very end, who owns that. Which is, it can be used as an anonymous sources, but also it can be tracked now. It depends on the coins, obviously. No? But the main idea here is that the blockchain is public, and everybody can check, everybody can see what's going on, everybody can understand or at least see the source of transactions on the different coins. But the problem here is if everybody can put some numbers, everybody can make transactions, how we solve the consensus, how we put together all these networks that is competing each other, how we put all these nodes that are competing each other, how we decide which one is the one that can be the one that is the correct one. So basically, in the world, to reach consensus, they call it the Byzantine generals problem. Basically, the ones who solve that kind of problem, if there is a lieutenant in this kind of problem who is raw, is there a faulty, is there somebody who's a traitor, how everybody can put together and make one consensus in order to add a block into the blockchain. In order to solve this problem, people is coming with different ways. One of them is called proof of work, basically how much energy I put into the system, how much wealth is called proof of stake, or how much I enter in, how much is my stake into the system. So basically, in order to solve a problem, in order to get consensus, they have at least two different protocols. There are many other ones, but at least the two most important is called the proof of work. It's meaning that it's a requirement how much computer power I put into to work, basically how many computers, how much energy, how much facilities, how much in terms of effort I put in order to solve a math problem, in order to demonstrate to the network that I've been doing some work. After that, the group will vote, basically, will broadcast the problem, who solved the problems, and everybody in the network will vote and will assign to that one that the one who is the one who will get in this case the prize, in this case of Bitcoin, who will get the coin in order to be the one who owns the Bitcoin and the one who put the block into the blockchain. In other cases, the proof of stake, when the creator of the block is assigned because of the stake or the wealth he put into that, so there is a system of probabilities how it will assign to the people who put into the block and the blockchain. So in order to avoid rock nodes, people who wants to be faulty into the network, that's the reason that is beautiful in blockchain. You need a lot of computer power to create a block without the authorization of the other, without reaching consensus. Let's say everybody's working in the math problem to solve the very last block, no? Basically, everybody's working. If you want to change the ledger, you have not only to win the competition for the very last block, but also to change all the previous blocks that is being written on the ledger. So that means you have to have a lot of computer power, not only to change the very last block that is at this moment working, but also to change all the ones. That means disincentive in order for a faulty node in order to create a different block. That means also an interest in that the blockchain cannot be changed easily. The blockchain cannot be, that's very difficult to change, which is an interesting factor because, as we said, the ledger, if it's controlled by a centralized system, can be changed by the guy who's basically controlling the database. But in this case, in order to change the database, you need to put together a lot of computer power in order to change the database. It's considered very difficult. It's considered almost impossible how much power you need to put into the system in order to change that block. So the probabilities of the ledger being changed is very low, which means that the ledger is immutable. Basically, the people consider whatever is in the blockchain is immutable. Whatever is there, in order to change it, it's almost impossible. So that is an interesting factor on the blockchain because that could be used for so many applications we will talk later. But what happens if somebody is not in agreement? What happens if somebody is not in agreement with the protocol or how to put a block into the blockchain? So the fork comes. So you may hear in the news, no, every once in a while there is somebody who's not in agreement on how the protocol is managed or how the voting system is managed, or somehow the people is not in agreement on terms of what's going inside the blockchain. Basically, you can fork. Basically, a group of people that is not in agreement, they use the same base of chain and can create their own new coins, or they can create their own new protocol. It's an open source. Everybody can read the document. Everybody can read the software. Everybody can tweak the software and create their own coins or create their own cryptocurrencies. You can use the ledger that is already there, and then you fork to a new ledger. Basically, you fork to a new cryptocurrency. That creates a lot of debate. Today, for example, people are debating about the Ethereum blockchain regarding the voting system, what they have, so it may create a fork. From time to time, people think the Bitcoin ledger, which is the very first one, is not enough, or is too expensive, or is too slow, so basically they create a new one based on their own beliefs. You can create your own private ledger. You can create your own private, you can create your own permissionless or your permission blockchains. Basically, it's an open world. That's the reason that today we have almost 1,500 coins in the world, because so easily to create one. There are obviously a lot of one that is basically no value, but in terms of the source of the system, you can basically do your own private ledger. So what happened is that what's going on in the computers, they're solving a math problem. Usually it's a worthless process in terms of the math problem they're solving. At least in Bitcoin, it's not a lot of energy basically wasted. So they say, what happened instead of solving a math problem, we run a software. So the idea of this new protocol is that instead of solving a math problem, we run a software program, a code basically. If we put a code inside and everybody, all the computers across the board, which are participant of the network, can run this program, and the inputs and outputs of that program is written in a new ledger, and everybody has a consensus that whatever is the output of that program is in there, it could be what they call a world computer, and it could be called what they call a smart contract. Basically, it's a software, it's a protocol again, that can be run in all the computers across the nodes in the network, and whatever outputs in there, it will be written immutable in a blockchain or in a consensus ledger. That smart contract concept opened a new set of businesses, a new set of ideas that later on I will try to explain a little bit of. For us, for example, the smart contract, we are trying to do, for example, an investment contract where people send money, the software will distribute the money among the parties who invested, and it depends on the profit of whatever the investment we did, it will sell the profit, it will send the profits to all the investors without the participation of any banks, any centralized authority. I will talk later a little bit more about what's going on in the smart contract. So basically, what is the blockchain? Is a data storage? Yes, because there is a database at the end. It's a transaction block? Yes, because all the transactions are stored and put in an orderly fashion in a database. Use cryptographic and digital signatures in order to be secure. It can be replicated across the distributed networks. Basically, everybody can have whatever is in the database. It drives consensus. It depends on different options how to drive consensus. It's a decentralized, a distributed system because, as I said, everybody can have a copy of that database. And what people like a lot is an auditable trade because you can see what's going on from the very beginning. So at the end, blockchain, it opens the world to a new businesses ideas because of this opportunity on having on the cryptographic world. Let me give you some sort of overflight about what's going on in crypto assets world. You know, from the very beginning, we start using forms of exchange of value. You know, paper, gold. Nowadays, we can exchange information. Because of the blockchain, we can send information to a party, to another party, securely send that information, and we can verify that information in a blockchain. We can always assign that set of information value. It could be just information, or we can assign as a community participant in the network that set of information values something. If you look at all the coins across the world, none of them, basically I'm talking about the currencies across the world, none of them have some sort of, backup or some sort of asset behind that. It's mostly based on the confidence of those currency. In this case, we can assign value because of the confidence the network has that the information has some value, or because we can assign some value to a house, or we can assign any asset that we want. So basically, the blockchain allows to a piece of information, to a piece of software, to be assigned some sort of value. And that's basically the idea of, that's maybe the reason we call at the very beginning, when the Bitcoin was born, as a currency. Because that piece of information, somehow it can be assigned on some sort of value, and we can transmit that value. There are many today's discussions about if the cryptocurrencies are really money. Now remember the definition of money, the uses of money, it has to have at least these three things. It has to be a medium of exchange, it has to be a unit of account, and it has to be a stable store of value. All those three things, in order to be called money, I think nowadays none of the cryptocurrency has that complete accomplished yet that three characteristics of money. Because yes, it can be a medium exchange. Definitely, it's very easily to know because you're changing information. You know exactly what you're exchanging. Unit of account is very good also because you can exchange that. What is in discussion because of the volatility that's going on in the cryptocurrencies world is so high that there is a discussion if there really, really is a stable store of value. But what's really good on the cryptocurrencies, all the characteristics of the money, basically the durability, the portability, the acceptability, some sort of acceptability, the disability, they're really good characteristics that can be applied to cryptocurrencies. So it's still out there. We call it cryptocurrencies, but money no so yet. Maybe because it's so young, this industry, less than 10 years old, it will have to have a lot of more time in order to settle if we can use this as a real money. What is interesting is the properties of these currencies or of these tokens are so good that can be used for several things, not only because of money. You know, whatever goes into blockchain is irreversible. Whatever is very difficult, at least, to change. It's some sort of fast and global. You know, there is no country limits, there are no geography limits, etc. It is secure. It can be permissionless. Basically, anybody can access to the technology, and it can be anonymous or some sort of anonymous in terms of who goes into or what's going on inside there. So those properties, those 5 properties is basically, I think, the reason that the surge of the cryptocurrency in the last few years. One way to look at the world, we need this kind of taxonomy because we are trying to value the space at this moment. So I think one idea to propose in order to separate what's going in the market is to separate at least in these 3 categories. You know, we call it the cryptocurrencies, those that try to simulate the money, those that try to have the properties of money, of medium of exchange, unit of account, or store of value. Then we can have those cryptocurrencies or those tokens that will try to simulate the commodities of the digital world, basically the computer power, storage capacity, bandwidth, basically the commodity, digital commodities. And then we can put all those together, the currencies and the commodities, and start getting some final goods and services. So what we call the digital tokens. The digital tokens basically is some sort of the final product or the final service related to the digital world, like tokens to access to gaming, to social media, or to lending, for example, whatever final product we can create in this world. Given that taxonomy, given that categorization, we can think about different ways to value. We are working right now on different protocols, on different algorithms in order to value the fundamental value of those. There are a new category that's going on. It's called the crypto collectibles. If you have heard about the cryptocurrencies, basically it's a uniqueness of the ledger. Some information in the blockchain or in some blockchain that will be unique is called the cryptocurrencies. Today or yesterday, They launched the crypto pandas, the crypto whatever, crypto bunnies. And it's interesting because that gaining value, because people somehow, they assign value to those things, and they are exchanging those things, and they're paying money for those things. So maybe there's a new category going on in the next few days. We will call it the crypto collectibles. In order to understand the world, I think it's very interesting to separate in those three basically categories and how we can value that. As yesterday, despite the fact there are more than 1,500 tokens in the world, exchanged in more than 9,000 markets in the world, there are 8, maybe 10, sometimes 8 cryptocurrencies that basically have around 85% of the market capital of the world. So mainly, as you can see, out of those 1,500 that are in the world, there are so many what we call the crypto zombies, basically scams or some idea that never went through. So since this is not regulated yet, since this is global, since this is permissionless, since this open source, since this is anybody can access, that's one of the reasons I think the explosion that happened in the last couple of years is because of that specific reasons. So anyone can think on an idea, can think on a scam, can think in whatever positive or negative ways, and create their own currency and try to sell it to the world. That's the reason, as of today, we can see all the volatility that's going on in the market. We are in a very infant industry, but Bitcoin was the mother of all these ideas. Bitcoin is maybe not the best protocol, but at least is the original one. That's the reason maybe it's around 50% of the market. Then you have Ethereum, which is most related to a smart contract, and then you have all the other currencies that have some specific feature that can be used for different ideas. What happened is, if you see the value of this, it's not too much, at least. No, it's still a few billions, but if you compare whatever other industry, it's still a small one. But what happened in terms of value is it can attract, if people see that 2 years ago, 3 years ago, it can attract a lot of speculators, and it can attract a lot of people. You know, my daughter, 8 years old, is asking me for Bitcoins. There's an old saying, if the taxi driver give you some advice about a stock, it's time to sell that stock. But what happens if your daughter of 8 years old asks you for Bitcoin? Maybe that's the reason we sold all the Bitcoins in December. But somehow the millennials or those generations are looking at things differently. Obviously, when you see this sort of value, you can see people who made a lot of money obviously attract different kind of people that have been attracted for this kind of returns. And also you can see the altcoins now that is more than 50% of the market. All these new kind of ideas that created new coins competing against the Bitcoin, which is the main one, can think about, can make you think. And in December, we were like around here on the very peak. I think it was December 19. People were saying, oh, this is a bubble. And you can see all the chats, and you can see in all the Telegrams groups, you can see in all the social media, this chart, no? It's a bubble thing. It's a bubble. It's very similar. You know, it makes you think, you know, really makes you think. You see this chart, and you start. But the question is, we are here in the first half, or we are already in the other side. Obviously, everyone is guessing. Nobody knows. But if I had to guess, maybe we are close to this side already. we had to talk about bubbles, and it looks like the cryptocurrency is living a bouncing bubble. We have made some calculations every once in a while. There is 30, 40% corrections in price in different coins. Everybody's thinking about this volatility that's going in the market because it's still young. You can see from the very beginning the volatility of Bitcoin, at least in the case of Bitcoin, is going like 15, 20% compared with gold is basically, it's outrageous. For speculators, this is beauty. You can make a lot of money in these ones. No? Obviously, you have to have a lot of computer power in order to do this thing. Let me. Are we in time?
Yeah, we just made it last time.
Okay. Let me give you just one more thing about. People always ask me, what's going to happen in the blockchain? What's going to happen in the? Basically, if we have to see the crystal ball, I will see in the near term crypto commodities, everything digital. Basically, we'll digitalize everything. Whatever is digital, we will put a commodity or we will put a cryptocurrency. We will see, you can see registered equity tokens is going on. Later on in this conference, people will talk about that. All regulators in all over the world are stepping in while writing laws at the moment in different countries, participating in the writing the regulations. The taxman obviously is there. The governance organizations, people are using the cryptocurrency for governance in terms of how we will handle the corporations. Blockchain meets Internet of Things. Let me give you, remember I said that the silicone breast implant, we put a chip inside the breast implant. There are almost 300,000 implants on the world, like a lot of women very happy with that, but we put a chip inside. So now that chip is tagged to an app, and that app is tagged to an insurance, so now we can insurance through the blockchain the breast implant. So the Internet of Things is going all over the place. Basically, people will put crypto, we will put crypto in everything that you can imagine, even inside the body. We will expand more than financial services and insurance, but also in freight and logistics. There are people who are also working in the smart contract ecosystem. Smart contracts talking with another smart contract, talking with another smart contract, are doing some stuff by themselves. And obviously, we do believe that Bitcoin will reach the $100,000 somehow in the near future.